All right, let's consider those two questions that all of us have thought about at one time or another that are lurking in the back of our minds. What is accounting and why does accounting exist? It's time to confront those two questions. What and why? Before we tackle the reasons for the existence of accounting, let's set our sights a little lower and we'll just talk about bookkeeping. Bookkeeping, very simple thing. It's just the preservation of a systematic quantitative record, numbers of an activity. You get a report from your phone company every month, your phone records. It's just a quantitative record of your phone calls that month. If you're a landlord, you're going to keep track of who paid their rent, who didn't pay their rent. Class grading records. Trust me, if you're an instructor for a class, you better have some records on which you can give grades on a reasonable basis. Sports statistics. Think about Major League Baseball, football, basketball, any sport that you can think of. A primary function of somebody within that sport is to generate the numbers, the statistics. That's just bookkeeping. It's awesome, but it's just bookkeeping. Bookkeeping, as you can see, permeates our society. Let's do an uncomfortable thought experiment. Let's say that tonight all novels and all college professors, those two are going to disappear tonight. So you wake up tomorrow morning, all the novel. I got a novel right here, cheaper by the dozen, is gone tomorrow. I've got a college professor right here, gone tomorrow. Horrible loss, especially for those of us who would disappear. But normal life will continue. If I don't have the novels, horrible cultural loss, but society can still continue. Without all the college professors, yeah, we'll miss them for a while, but life, normal life for the large majority of people, the vast majority of people could continue. But what if bookkeeping records were to disappear? All bank records, all business account records, all college grading records, all those simple bookkeeping things, the records at the dry cleaner, all those simple things, they disappear overnight. Society shuts down. Bookkeeping sounds boring. We're just keeping a numerical record of what happened. You lose all those records overnight. Society shuts down the next day. You go to the bank, say, I'd like to take some money out. Forget it. They don't know how much money you've got. You go to pick up your dry cleaning. They don't know what's yours and what's not yours. Your instructor loses all the college grading records, has to give grades. All the bookkeeping records are gone. Nightmare. Society shuts down without simple bookkeeping. It's a bedrock. So exactly how old is accounting, bookkeeping, and accounting? Well, clay tokens have been found in Mesopotamia, over here in the Fertile Crescent from 7,000 years ago. What were they used for? Well, farmers back in those days, they wanted to know, how much wheat do I have? How many sheep do I have? How many? And is it more than last year, less than last year? We want to keep track of those things. So accounting is old, 7,000 years old. In fact, some people think that bookkeeping predates writing and bookkeeping led to writing. Is accounting older than writing? Yeah. How important is accounting? It's crucial. Let's look at a practical example of difference between bookkeeping and accounting. We'll use your checking account, and I apologize for bringing this up because for some of you, you don't like thinking about your checking account. So let's be gentle here. So bookkeeping associated with your checking account. You're going to record each transaction, or if you use a debit card all the time, your bank's going to record each transaction, the date, who you're paying the money to, how much it is, and maybe the purpose, or maybe not the purpose. Oftentimes you don't report the purpose. So simple bookkeeping is just going to be those things right there. All right. Now, what's the difference between that, simple bookkeeping, and accounting? Well, accounting, you're going to use careful judgment in categorizing the transactions. You're going to do an analysis of non-routine events. So let's say you paid for one payment, but it was for three different things. Part of it was for your electricity. Part of it was for your rent. Part of it was for your food. One big payment. We got to separate that out. You're going to produce accounting. You're going to produce relevant reports. You're going to analyze the past. You're going to say, okay, how much did I pay for food last month? And was that more or less than the same month the year before? And how about my total expenditures for housing and electricity and all those things, more or less than last year? And going forward, am I going to have enough money next month, next year to do what I want to do? Accounting is structuring the bookkeeping data so you can make decisions. Bookkeeping, just getting stuff down, having a record. Accounting, structuring that information so I can use it to analyze the past and make decisions about the future. Bookkeeping, routine. Accounting, now I'm structuring the data to make higher level decisions. The dual function of an accounting system, do the routine bookkeeping. Let's just keep get stuff written down, because if it's never written down, we can't do anything with it. It's got to start right there. Get it written down. Once it's written down, then the accounting system takes it to the next level. Let's structure it so we can do some analysis. We'll organize and evaluate this accounting information. We get it all down, then we structure it so we can analyze it. Bookkeeping, getting it all down. Accounting, let's structure this information so we can now do some analysis. We can do some forecasting. We can make some decisions. Let's define the word accounting. Sure, lots of you have been approached by people who say, hey, what is accounting exactly? Define the word. You haven't been able to give a good answer until now. Accounting is quantitative information. That means we're talking about numbers. We're not surprised by that. Primarily financial in nature. So we're talking about money, numbers and money. Numbers about money. Okay, so accounting, we suspected that. We're dealing with numbers that relate to money. Accounting, it has to be useful. I mean, there's a beautiful accounting theory, and we can have a long, nice discussion. Come to my house sometime, we're going to do it about accounting theory. But the focus of accounting is not on theory. The focus on accounting is usefulness. Usefulness in what? In making decisions. Accounting focuses, although not completely, but focuses on past information. But that past information is going to inform us and tell us how to make better decisions for the future. So accounting, quantitative information, primarily financial in nature, about money, and accounting is designed to be useful in making decisions to change what's going to happen in the future. Let's talk about some of the most important things in accounting, the financial statements. The financial statements are going to become your friend. Accounting is a generic label. There are specific types of accounting. The two primary areas within accounting are financial accounting and managerial accounting. Managerial accounting is the information that's used inside a business. People outside the business don't know this. So it's the detailed information that's used inside a business to make those day-to-day operations. That's called managerial accounting, the internal information. Financial accounting, those are the summary reports that are given to people outside the business. Banks, potential investors. Financial accounting is summary information given to outsiders. Financial accounting, summary information given to outsiders. Managerial information is detailed information used by insiders to make decisions on a day-to-day basis. Financial, managerial. Remember that managerial accounting relates to internal information. So what are we talking about? Product costs. I don't want my competitors to know what it costs me to make my product or to provide my service. That's internal information. I keep that internally to make decisions. Break-even analysis. How many customers have to come to my restaurant so I can avoid having a loss, so I can just barely break even? Budgeting. I'm not going to release my budgets to the public unless it serves some strategic need for me. Typically, I keep my budget information internal, private. That's used for internal decision-making. Performance evaluation. How about that head of that division? How about the head of that department? I'm going to have performance evaluation numbers, internal managerial accounting numbers to evaluate their performance. Making decisions. Do I want to outsource production? Do I want to make it myself? Do I want to build my factory in Wyoming? Or do I want to move it to Vancouver, British Columbia? Or do I want to move it to Indonesia, perhaps? All the detailed information to make those decisions, that's all managerial accounting information used by insiders to make detailed day-to-day decisions. Financial accounting, summary information given to people outside, external users. So I want to get a loan from a bank. I provide that bank with financial accounting information, summary reports of how I've done. So used for credit analysis, regulatory uses. So if you're a bank or you're an insurance company, you're going to have to send summary reports, financial accounting reports to the state insurance regulator, to the bank regulators. They're going to use those to evaluate your performance. Or maybe somebody wants to invest in my company. Maybe somebody wants to buy my company. They're going to use financial accounting information to estimate the value of my company. Financial accounting information is used by people outside the company to make decisions like, should I loan money to the company? Should I buy the company? How much should I pay? Managerial accounting information is used by people inside the company to make detailed day-to-day operational decisions. Financial accounting, managerial accounting. Managerial inside, financial outside. The heart of financial accounting is the financial statements. There are three of them: the balance sheet, the income statement, the statement of cash flows. So when we talk about financial accounting, really we're talking about communicating with people inside or outside, outside the company, and we do it using these three reports. So you can think of financial accounting as being focused on three pieces of paper, three reports, one-page reports to tell people a summary of how my company is doing. So balance sheet, it's a list as of a point in time, and it just tells people what resources do I have and what obligations do I have. I mean, that's natural. That's what you want. Hey, your company, you want to borrow money from me? Well, tell me what assets you've got, what resources you've got, and what obligations do you already have? To whom else do you already owe money? That's a balance sheet as of any point in time. An income statement, hey, how much did you make? So for this year or this month or this quarter, how much do you make? That tells me something about the financial strength of a company. And the statement of cash flows, I mean, if you're going to run a business, you got to be able to manage the cash in and the cash out and make sure that you've got enough cash to handle the needs that are coming up soon. So a statement of cash flows is for a period of time, again, for a year, for example. Where did our cash come from and what do we use it for? That's the statement of cash flow. So the three financial statements: balance sheet, as of a point in time, what do we got and what do we owe? An income statement, how much did we make? Statement of cash for a period, for a year. Statement of cash flows for that same year, for that same month, or for that same quarter. Where do we get our cash from and what do we spend it on? Those are the three financial statements. The balance sheet is built around this simple accounting equation. This accounting equation is over 500 years, and it's a very simple but powerful insight. Assets. If you've got a business, of course, you're going to want a list of the stuff that you've got, the stuff that you own, the valuable things. Assets like cash and land and buildings and other things like that. Your assets. The inside of the accounting equation that goes back to Italy over 500 years ago is this. Let's not just keep track of a simple listing of our assets. Let's also keep track of where we got the money to buy those assets, the sources of financing. We can either borrow the money, in which case we call the source of the money to get that asset a liability, or the money could be invested by the owners, either directly out of the owner's personal savings, or the owners could use the business to generate a profit and say, let's put that profit back in the business. Either way, it's the owners investing in the business. So I've got assets. Where did I get the money to buy those assets? And this, of course, has to be true by definition. If you've got assets, you had to get money to buy those assets. So the assets and the sources of financing to buy those assets have to be equal by definition. That's the accounting equation. It underlies the balance sheet. It's a very powerful, powerful notion. So let's look at the balance sheet of an actual company. This is Walmart. This is their balance sheet as of January 31st, 2013. They call this their 2012 balance sheet, even though they do it on January 31st, 2013. By the way, why do they wait till January 31st? What's wrong with December 31st? Because they're busy doing business on December 31st. It's a busy time for a retailer, so they wait until things die down till the end of January. Then they prepare their balance sheet. It's a listing of their assets. All things here are in millions. So they've got some cash, $7,781,000,000. They've got some property and equipment, land and buildings. They've got some inventory, the stuff on their shelves, $43 billion worth of that. Total assets of Walmart as of January 31st, 2013, $203 billion. That's how much Walmart has in assets. Now you should be asking yourself, okay, they got $203 billion worth of assets. Where'd they get the money to buy those assets? That's the other part of the balance sheet. As of January 31st, 2013, Walmart had $203 billion in assets. Where did Walmart get the money to buy those assets? Well, some of it came from what they call long-term debt here, about $38 billion. They borrowed $38 billion on a long-term basis, which means they're going to pay it back in 5 years or 10 years or whatever to buy some of those assets, about $38 billion worth. What else? Well, their suppliers, accounts payable, they bought some stuff on credit from their suppliers, primarily inventory, about $38 billion. So that's another big source of financing for Walmart. Let's look at one of the biggest sources, in fact, the biggest source, retained earnings, $73 billion. That's profits that have been generated by the company Walmart since they started clear back in 1962, that have been kept inside the business. The owners of the business, the shareholders, have said, now those are profits, those belong to us. Let's plow them back into the business. That's a huge source of financing for Walmart. More than 1/3 of their assets have been purchased with profits that have been generated and kept inside the business. So the balance sheet shows us the assets, the stuff that we've got, and it also shows us, as we see here, where do we get the money to buy those assets? The balance sheet is a very useful report, and it's a summary report, but there's a lot of stuff on that one summary report, the balance sheet. Another fundamental financial statement is the income statement. I don't need to tell you much about the income statement. Yeah, everybody knows what income is. Revenues, how much did I generate from my customers? Expenses, what did I have to pay in my business expenses for my electricity, for my taxes, for my wages for my employees? And I take the difference between those two, that's net income. Net income is often spoken of as the focus of the accounting system. I want to know how the business did. This is the measure of the economic performance. How much profit was generated by the business? That's the bottom line. When people talk about the bottom line, that's it. Net income, bottom line. Revenues minus expenses on the income statement tells us net income. That's the bottom line. Well, let's look at the bottom line or net income for Walmart. We'll look at the income statement for Walmart for the year ended January 31st, 2013. So an income statement is for a period. Remember, a balance sheet is as of a date, January 31st, 2013, or December 31st, or whatever. As of a certain point in time, it's a snapshot, a photograph of a company. What assets, what obligations do you have right now? An income statement, in contrast, is for a period of time. How much did you make today? How much did you make for this month? How much did you make for this year? Well, this happens to be a report for Walmart for a year. The year ended January 31st, 2013. Remember, an income statement is for a period of time, a year. And we go down to the bottom line. We see income attributable to the Walmart shareholders, about almost exactly $17 billion, $16,999 million. That's the economic profit generated by Walmart for the year. They had sales of $466 billion. That's worldwide sales for the year. Then they had to pay expenses. They had to pay for the inventory that they sold. They had to pay operating expenses like electricity, employee wages. They had to pay interest of about $2 billion. They had a tax obligation of about $8 billion. You take out all those expenses. Sales initially $466 billion. You take out all the expense and you're left with about $17 billion in net income. Bottom line, that's the profit of Walmart. That's the income statement. If I've got a company, yeah, I want a report telling me how much money the company made. That's what we see in the income statement. The third primary financial statement is the statement of cash flows. And if my brother were here, he'd say, statement of cash flows, if you want to know what that means, just say it slowly. The statement of cash flows is the statement of cash flows. That's it. Cash flows in, cash flows out. This is just a statement that summarizes that. So inflows of cash, where can we get them from? Well, we can sell stuff and collect cash from our customers. Maybe we'll sell an old building, we'll sell some old land. Maybe we'll borrow some money or we'll get some cash in from shareholders. Okay, what would we spend that cash on? Well, maybe we got to pay some wages. We got to pay taxes. Don't forget to pay your taxes. Maybe we're going to buy a new building. We're going to buy some new land. That's cash out. Maybe we're going to repay some loans. We're going to pay dividends to shareholders or distributions to partners. So cash comes in, cash goes out. That's all that's in the statement of cash flow. So conceptually, it's a pretty simple report. Cash came in. Where did it come from? Cash went out. What did it go out for? In the statement of cash flows are categorized into three areas: operating activities, investing activities, and financing activities. Operating activities are the things that I do every single day. I collect cash from my customers. I pay cash to my employees every single day. Investing activities, that's investing in the productive capacity of my business, buying new buildings, buying new machinery, selling old buildings when I'm done with them. Those are investing activities. So it's not investing as we think of it usually in terms of stocks and bonds. It's investing in the productive capacity of my business, buying machines, buying equipment, buying buildings. Financing activities, that's exactly what it sounds like. Borrowing money from banks, that's a financing activity. Getting money from investors, paying dividends, paying back loans, those are all financing activities. So we see this here for Walmart, again, for the year ended January 31st, 2013. And a statement of cash flows has to be for a period of time. Here, my cash flowed today, this week, this month, this year is what we're talking about. So we see in the year ended January 31st, 2013, the operations of Walmart generated, what is it? A little bit over $25 billion in cash. So plus $25 billion. What did they use that cash for? Well, some of it they used in their investing activities, buying new buildings, property, plant, equipment, land for new locations, building new locations, trucks, all those things. They spent about $13 billion. So this, by the way, we can stop right here and do a little financial statement analysis. Their operations generated a bit over $25 billion, and they used a little less than $13 billion of that in paying for all the new stuff that they needed. Is that a good situation to be in? Yeah, that's a very good situation to be in. That's called, and I'll just tell you this right now, that's called being a cash cow. You're a cash cow if your daily operations generate enough cash so you can buy all your buildings and your machines and your trucks and whatever else you want for cash. How would you like to, in your personal life to be a cash cow? Well, Walmart's a cash cow. What do they use some of that, the cash they're generating, the surplus cash? Well, they're paying dividends to shareholders and other financing activities, operating day-to-day things, investing in the productive capacity of the business, financing, getting money from loans, paying back old loans, paying dividends to shareholders. You add those three up, and that's your change in cash for the period. Statement of cash flows, a very powerful and interesting report, and conceptually, a very simple report. Makes a lot of sense. Operating, investing, financing. The financial statements tell us about the past, and people often criticize accounting and say, well, you're looking at the past. Okay, but the past, remember, accounting is focused on helping us make better decisions. Decisions are going to impact the future. So how can knowing about the past help us make decisions that are going to impact our future first? Knowing about the past will help us evaluate the results of our past decisions. Hey, we decided to do this last year, and let's take a look at our balance sheet, our income statement, statement of cash flows. That was good. That was bad. Let's do that again. Let's not do that again. We can evaluate our past decisions, and we can project the effects of our future decisions. So yes, financial statements tell us about the past, and they help us evaluate the decisions we made in the past so we can make better decisions going forward in the future. Accounting is about making useful decisions, useful decisions to change the future direction of our organization. Yeah, it's the past, but we're looking to the future. Who uses financial accounting information? And we're going to find out that many people use financial accounting information. And the question perhaps you should be asking yourself is, are you using financial accounting information? Maybe you should use it a little bit more. Financial accounting information, of course, is focused on the people outside the company. The two biggest groups outside the company are lenders and investors. So how would a lender use financial accounting information? Well, you give the lender, when you go for a loan, the lender will say, okay, I'd like to see your balance sheet, income statement. And if it's a really good lender, I'd like to see your statement of cash flows. And what's the lender going to do? Well, is this loan going to be repaid? What's your current income? What are your existing obligations? Your existing assets? Are you going to be able to pay this money back? That's what a lender is going to use the financial accounting data for. How about an investor? If I'm thinking of buying into a business or buying a business, okay, is the business making any money now? What's the potential for the future? What assets would I be buying if I bought this business? What obligations does this business have? So yes, the two key crucial users of financial accounting information, they're outside the company. Lenders, should we loan the money? Investors, should we invest in the company? Those are the key external users of financial accounting information. Can people inside the company use financial accounting information? Remember, financial accounting information is designed for people outside the company. Internal accounting information, managerial accounting information is that detailed stuff that is used on a daily basis. But hey, if I'm the manager of a company and I'm preparing these financial accounting data, these reports to be used by outsiders, I can look at them too. And what might the management of a company do? Well, let's plan a little bit. Let's see how we did last year. Let's see where we are right now. Let's make a plan based on our summary reports. Yeah, I've got more detailed data, but this gives me a nice snapshot to see what's going on. Daily monitoring. I'm going to use this financial accounting information maybe to see what do I need to keep track of? What went off the track last year based on my financial accounting information? And evaluation. Hey, you, head of that division, you had a target for the year. We're going to reach this much net income. Didn't reach it. I'm going to evaluate you negatively based on that information. So yeah, management of a company can certainly use financial accounting information. They're inside the company. So managers of a company, people inside the company are going to use both managerial accounting information. And since you've got the financial accounting information, let's also use it as well. Financial accounting information is targeted to people outside the company. They're publicly available. If you're a publicly traded company, they're out there. So if you wanted to see the balance sheet of Apple right now, you can go online and get it. Or Microsoft, or McDonald's, or ExxonMobil. You can see them right now. We're outside the company, but their financial accounting data, since they're public companies, are out there. So what might people outside the company use these summary reports, the balance sheet, the income statement, the statement of cash flows? What might external users use these for? Well, if you're a supplier and you've got a company comes to you and says, listen, I want to buy from you on credit. We've never done it before. Let's get a business relationship going. Hey, let's see your financial statements, balance sheet, income statement, statement, cash flows, because I want to know, can you pay? So suppliers often want to see financial accounting data. Customers, if a customer is thinking of getting into a long-term business relationship with you, the customer wants to know, are you going to be around in the future? If you look like you're going to go bankrupt next week or next year, I don't want to sign a long-term contract with you. I need a reliable supplier of some key raw material. I need to know about your financial health. So customers often want to see financial accounting data. Employees, can you pay my wages? Are you going to be around for the long term? You can see this one all the time in labor negotiations. Periodically, you'll see Major League Baseball or the NBA or National Football Players Union negotiate a new collective bargaining agreement with the owners. Key piece of information to the financial accounting data, because the owner is saying, oh, we're not making any money. And the players are saying, well, let's open up the books. Let's see the books. Let's see the financial accounting data. So yeah, employees, there's a nasty one. You're going to make these data available publicly outside for external users. Who's going to pick them up? Your competitors are. Hey, how you doing? Are you making money? What is your cost structure? We can determine that a little bit from your income statement. What is your asset structure? What assets do you have? How are you financing these things? What are your weaknesses? What's going on? Yeah, your competitors are going to look at those financial accounting data. You'd rather they not have them, but there's nothing you can do about it. If you're a public company, you got to put them out there and your competitors are going to look at them. Government agencies. Let's say, for example, that you claim that you've been harmed by imports, low cost, below cost imports from some other country. Well, you got to show that harm by demonstrating your income statement. Look, here was our income. It was okay. It was okay. And then these low cost imports came in and our company suffered. We had to lay off workers and it's horrible. We can't pay our taxes anymore. So government agencies, bank regulators are going to look at the financial statements of banks to see if the banks are strong. So yeah, government agencies are going to use financial accounting data. Politicians, in order to make a point, I'm a politician from a certain state. I want to show that companies in my state have been harmed by low-cost foreign imports or by bad labor relations or whatever else that I have a point I want to make. I can use financial accounting data. There are lots of them out there, so politicians can make points using financial accounting data. The press. I'm writing an article about a company, financial accounting data. Hey, ExxonMobil, blah, blah, blah. Here's how much money they made last year. Here's how many assets they've got. Or sometimes the financial accounting data can be an investigation trigger. Apple just announced these earnings. That's a little different than we thought. Let's go do a little investigation. Facebook just announced their earnings and they were much lower than we thought. Is there a scandal going on here? What's going on? You see how a financial accounting information might trigger an investigative reporter to start looking and say, what's going on behind these numbers? Who uses financial accounting data? Well, it turns out that just about everybody does. Are you using them enough? That's the question I want you to think about. The need for financial accounting standards, rules on how everybody should do it. Is there a need for financial accounting standards? Yeah, there is. We need to see why and who makes these rules. Let me give you an illustration of why we need accounting rules or standards. Let's consider how to report land. I got a balance sheet where I'm going to report my assets. How should I report land on my balance sheet? I've got some land here. Should I report it at my original purchase price, the cost of the land, or its current market price, what accountants call the fair value? Which should I report, cost or fair value? Or should each company just choose what they want? Hey, well, one company says we'll report the cost of our land, another company reports the fair value of the land. You see the issue. How much we report the land, at what we pay for it or what it's worth today? Should there be a rule or should each company be allowed to choose on their own? That's the question, ladies and gentlemen. Let's do another illustration of why we need some accounting rules. Compensation expense. How much does it cost for me to have a key employee on staff? Well, I pay this employee in three ways. I pay him a cash salary of $80,000. I also give him a new car this year that has a cost of $30,000. Give him a salary 30,000 or 80,000. Gave him a car for 30,000. I also gave him an option to become a 10% owner of the company after 1 year. They have to pay me 20,000 to become an owner. So it's an option. They don't have to become an owner after 1 year. But if they work for me this year, at the end of the year, if they want to become an owner, a 10% owner, they give me 200,000, they're a 10% owner. Now, I have options like this that the company, sell to outsiders. I sell them for 25,000. It's a valuable thing. Why would this option be valuable? If the company goes up in value during that year, do you want to be an owner of that company? Yeah, you do. So there's a chance that this could be a home run. There's huge upside here. So this is a valuable thing to have. This option is a valuable piece of paper. And I say to my employee, hey, you work for me for the year? I'll give you one of these options. I'm giving you three things to work for me. Three things to induce you to give up your valuable time to work for me. I'm giving you a cash salary of 80,000. I'm giving you a new car that has a price of 30,000. I'm giving you an option to become an owner after 1 year. Okay, give me the number. What's compensation expense? How much am I paying this employee? What's the total package? How do I do that? How do I compute that? That's the accounting question. Let's think about that. What's compensation expense? Well, the salary, 80,000, that's easy. The car, yeah, okay, it's not cash, but still it's worth 80,000. So, okay, those are easy. How about the option? Is the option part of what I'm paying to my employee? Now, one side of you says, well, yeah, it is, because these options are valuable things. You're selling these to other people for 25,000. So one way to think of this is I've given my employee a piece of paper worth $25,000 in exchange for their working for me. So yeah, that should be factored in a compensation expense. But another way to think of it is, wait, this option doesn't really cost me anything. I don't agree with this thinking, but I hear this all the time. It's not costing me anything. In fact, what this piece of paper does is make it so that there's more likely that at the end of the year, the employee is going to say, hey, I want to become an owner in the company. Here's $20,000 or $200,000 to become a 10% owner. So this piece of paper actually increases the likelihood that the employee is going to invest in the company, $200,000 in the future. So is the option part of compensation or not? Should I say, well, these things are worth 25,000. That's why I sell them to for other people. Or no, there's no real cost here. It just increases the likelihood that this employee is going to become an owner. Is it compensation or is it not? There's the question. So what is compensation expense? Is the option compensation or no? We're not going to tell you the answer to that question. It's a really interesting question and a surprisingly controversial question, but now is not the time to discuss it. The point is this: should each company be allowed to decide on their own how to account for these options? Well, no, that would be horrible accounting. Should each company be allowed to decide on their own? I'm going to report my land at cost. I'm going to report my land at its current fair value. No, that's horrible. There needs to be some uniformity here. We like everybody to do their accounting the same so the reports are more useful. No, we don't want every company to do it their own way. And these are just a couple of accounting issues. There are lots of them. Revenue recognition. When should companies report sales? Should they report it now or do they have to wait until next year? It's a big deal. How about leases? How should leases be accounted for? Holy cow. That's that one little word there, leases, in accounting terms, one of the most controversial words there is, and it all relates to how should companies account for their leases? Is there going to be a standard rule? Environmental liabilities. If I've done some damage to the environment, how do I compute how much damage? Where do I have to report that? How do I have to do it? Goodwill. Just what in the world is goodwill and how should it be reported? There are all kinds of accounting issues. And the question is, do we want a chaotic accounting world? Yeah, there is a need for financial accounting standards, for rules. Do we want each company to be allowed to set their rules themselves? No. We need comparability. External users, and who are those? Those are lenders like banks. Those are potential investors. External users need to be able to compare the financial statements of company A to company B. Well, we can't compare company A to company B. If company A is doing their accounting for their land and for their compensation expense and for their leases this way, and company B economically exactly the same, but has chosen to report their land and their compensation expense and their whatever was the other one I said, their leases in a different way, two economically exactly the same companies, but their accounting reports look different because they've chosen to use different rules. That doesn't work. We need accounting standards. Somebody's got to make rules so that everybody does it the same so we can compare. We're a bank or a potential investor. We can compare companies. There has to be comparability. There has to be. There need to be rules. Well, if there need to be rules, who's going to set them? Who? And we'll focus our attention for now on the United States. Who in the United States is going to set the accounting rules? Is it going to be me? Is it going to be you? Is it going to be my mom? Who's going to set the rules? Well, in the United States, right now, the rules are set by a group called the Financial Accounting Standards Board, the FASB, the FASB. Drop that into conversation next time you're talking with your friends. Hey, what about the FASB? FASB is not a governmental agency. It's not an arm of the U.S. federal government. It's a private group. It's a trade group is a way to think of it. It represents the business community, people experienced in business and accounting. There are 7 of them on this FASB. I'll write that out here. There are 7 board members. And their offices are at Norwalk, Connecticut, which is a ways outside of New York City. They make the rules so that everybody does it the same way. Now, hopefully their rules are good. But even if they're not good, I think they're good. But even if they're not good, at least they're the same for everybody. So there's some comparability. We can complain about the rules, but at least everybody's doing it the same. The rules they set are called Generally Accepted Accounting Principles, or GAAP. This is pronounced GAAP. GAAP. We don't say GAAP. We say GAAP. We do say FASB. But we don't say GAAP. We say GAAP. Generally Accepted Accounting Principles. Now remember, since this is not a government agency, there's no legal authority here of the FASB. No legal authority. They live based on their prestige, based on the fact that their rules are generally accepted. They make good accounting rules, and people have agreed in the United States, okay, their rules are good. We're going to follow their rules. Their credibility is very important, so they're very careful. Their process of making these rules is a very public process. They've got a hearing room. People can Skype in. People can listen to these things. They want to make sure there's huge transparency so everybody can see what the rules are. Everybody has a chance to put their input. But in the end, the FASB says, here's what the rules are. And in the United States, everybody abides by those rules. So we got some comparability. Who decides in the United States what the accounting rules are? The FASB. Why do we need accounting rules? We need them for comparability. If we're going to become knowledgeable about financial accounting, we need to know about accounting related organizations out there because we hear about these all the time in the press. So let's find out their names and their acronyms. A very important organization in accounting and in financial markets in general is the Securities and Exchange Commission of the United States, called the SEC. The SEC is responsible for ensuring that investors, creditors, and other financial statement users are provided with reliable information. SEC doesn't want you to be fooled. It's a U.S. government agency. It's a job to keep an eye on public corporations to make sure that they're not lying to people, they're not deceiving people. SEC is watching. U.S. government agency that's watching behavior in financial markets. Let's do a quick review of a portion of the United States Constitution. Article 1, Section 8, Clause 3 says that Congress has the power to regulate commerce, interstate commerce. Okay, well, part of interstate commerce is trading stocks and bonds across state boundaries. So Congress has constitutional authority to regulate that commerce. Congress has delegated that constitutional authority to the Securities and Exchange Commission, the SEC. The SEC was created by the Securities and Exchange Act of 1934 after some regulations were put in place in 1933 in response to some, and politely here, euphemistically, inventive disclosures that led in part to people being fooled, overpricing stocks, and then the stock market crash of 1929. So Congress has constitutional authority in the United States to regulate business and set accounting rules. They've delegated that to the SEC, the Securities and Exchange Commission. The SEC does lots of things, but one thing they do is they receive reports that are then disseminated publicly. So if you go to the website sec.gov, you'll find a repository for all kinds of public reports because the SEC wants transparency in the United States financial markets. Let's get the information out there so everybody can see what's going on. So there are registration statements, so often called a prospectus. If you're going to trade your securities, your stocks or bonds in the United States, okay, one of the rules is you got to tell everybody about your company. You got to release a prospectus before that new stock issue, before that IPO. Once you're a publicly traded company, every year you've got to file with the SEC a Form 10-K. It's filed annually. It contains audited financial statements so everybody can see your balance sheet, your income statement, your statement of cash flows. Also, every quarter you got to send one in. That's called the Form 10-Q. These are not audited, but they're looked at pretty carefully. So from an accounting standpoint, the Form 10-K and the Form 10-Q are very important, and those are publicly available. If you wanted to look and see how much money McDonald's made last quarter, you can go to sec.gov, and if you kind of trace around and know where to look, you can see McDonald's Form 10-Q, and it tells you exactly how much money they made last quarter. And finally, every year, another report that the SEC receives is called a proxy statement. There's Schedule 14A. It's filed annually in advance of the shareholders meeting, and it gives the most interesting part of my view, and most of these is it tells how much the top 5 executives made. So if you want to know of a certain company, what the top 5 executives made exactly, category by category, it'll tell you. Also, if there are any shareholder proposals that are going to be voted on, those are disclosed in this proxy statement, the Schedule 14A. So those are 4 important reports that the SEC collects and then disseminates so that people can understand what's going on in the market, so they've got the information available to them. So what can the SEC actually do? Well, the SEC has broad enforcement powers. Let's just look at some of the things the SEC can do. They oversee stock exchanges in the United States, and they can say, wow, we don't like the way you're doing it. You got to do it this way. They can suspend trading a specific company stock, or they can delist it altogether and say, you're done. You've been deceiving people. There's something funny going on here. We don't want the chance of anybody buying this stock under false pretenses, so you're done. You're delisted. If a broker or a dealer has been doing something that's untoward, then they're out too. The SEC can bar them. SEC can investigate suspected violations of SEC rules, and they write very interesting reports. Again, I'm going to write it down again, sec.gov. If you read their enforcement releases and other things, they're pretty lively writers. They'll tell you exactly what companies have done wrong. But let's bring this back to accounting. What does the SEC do with the accounting? The SEC has legal authority to establish accounting rules and disclosure requirements. They have the legal authority received from Congress. Where did Congress get it from? They got it from the Constitution of the United States. So here's how accounting rules work in the United States. Financial accounting rules. Legal authority, constitutional authority rests with Congress. Congress established the SEC back in 1934, and the SEC has legal authority in the United States to set financial accounting rules. The SEC has delegated that to the FASB, but the FASB has to be careful. They're always looking over their shoulders, making sure they're making good rules and being receptive to comments from people in business, from users of financial statements, and from government authorities, because whenever the SEC wants, the SEC could snap back that authority. They probably won't, but they could. There's the legal Constitution, gives the United States Congress legal authority to make financial accounting rules in the United States. They've delegated that to the SEC. The SEC is letting the FASB do it. And so the FASB creates GAAP, GAAP, generally accepted accounting principles in the United States. Another important accounting-related organization in the United States is the American Institute of Certified Public Accountants, the AICPA. The AICPA sets auditing standards for the people who check financial statements, and they want to know how are we supposed to do this. Those rules set by the AICPA or influenced by the AICPA. AICPA sponsors a continuing education. It has a code of professional conduct for professional accountants. It creates and monitors and administers the CPA exam that somebody has to pass before they can be a certified public accountant. Certified public accountant, turns out, is the only person that can sign an audit report, that can say to somebody, yes, I've looked at this company, I've looked at their financial statements, and those financial statements fairly reflect what's going on in that company. You have to be a CPA to do that. And the National Organization of CPAs, Certified Public Accountants, is the AICPA, a very important accounting-related organization. A trade group is what they are. It's not an accounting-related organization, but the Sarbanes-Oxley Act is very important to accounting. Some of you may recall back in late 2001, early 2002, there was an accounting nightmare. Enron, WorldCom, just one body blow after another. Senator Paul Sarbanes and Representative Michael Oxley in July 2002 are co-sponsors of a very important accounting-related act called the Sarbanes-Oxley Act. Accountants and business people talk about this act all the time. The Sarbanes-Oxley Act is often called SOX. Take the S and the OX, SOX for short. It's the most comprehensive legislation affecting financial reporting in the United States since the SEC was created by the acts of 1933 and 1934. So is the Sarbanes-Oxley Act a big deal? Yeah, look how big the print is here. That tells you what a big deal Sarbanes-Oxley or SOX is. It's huge. Among the things in the Sarbanes-Oxley Act, constraints on management. The CEO and the CFO of corporations now have to personally sign and put their reputations on the line whenever they send in financial reports to the SEC. Constraints on auditors, telling them what to do. And the Sarbanes-Oxley Act created the PCAOB, the Public Company Accounting Oversight Board. This is a very important organization created as part of the Sarbanes-Oxley Act. So this, the PCAOB, is an important accounting-related organization. By the way, I'll give you a tip. When people say this, the A is usually silent. I'll put a little thing here. So when I hear people say PCOB, PCOB is what they say. The A is silent. Okay, there you go. Just a little tip to show that you're in the know. So what is this PCAOB or PCOB that was created by the Sarbanes-Oxley Act? Well, this PCOB works under the supervision of the SEC. It's a private body, but the members are appointed by the SEC, and the SEC approves the action. So the PCAOB kind of sits here up to the side. They're watched over by the SEC, but they're actually a private group, very much like the FASB. Not exactly the same, but similar. So what does the PCAOB do? Well, they set governmental standards for audits. United States, audits of financial statements need to be done in this way. They do inspections of specific audits. They can do investigations if people say, hey, these accountants have been doing things right. These auditors haven't been doing things correctly. So the PCAOB is a very powerful organization created by the Sarbanes-Oxley Act, primarily to oversee auditors. Auditors then oversee companies and make sure their financial statements are done correctly. Now, when you signed up for this accounting class, you may have thought, okay, we're going to learn about taxes. Well, no, accounting and income taxes are not the same thing. Income tax accounting is one subfield of accounting, but it's not financial accounting. This is a course on financial accounting. The IRS is an important organization, but it's not crucial in the practice of those financial reports, the balance sheet and the income statement, the statement of cash flows. The IRS is different. The Internal Revenue Service, the IRS, it's a U.S. government agency that collects and regulates income taxes. In the famous Thor Power Tool case, a case before the United States Supreme Court, the United States Supreme Court summarized very nicely the difference between financial reporting and income tax reporting. Financial reporting is to make sure that people aren't misled, that they get accurate information. The primary goal of income tax reporting is to get the revenue collected. So two very different purposes. Financial accounting, the balance sheet, the income statement, and the statement of cash flows are to give information to people making decisions. Income tax reporting are just government rules to get the tax collected in a fair and equitable manner. So do companies have two sets of books? Yes, they do. One set of books that are prepared under the legal rules of the IRS so that the company can pay its tax bills and obey the law. And the other set of rules, they're related, but they're not the same, to be able to report to potential lenders, banks, potential investors. Okay, here's our balance sheet, here's our income statement, here's our statement of cash flows. Two different sets of rules. Yeah, two sets of books. Let's get an idea of the connection between these two sets of books, the tax books and the financial accounting books. Are there two sets of books? Yes, they are. Let's look at one end of the continuum. There's economic income, which is very subjective and based on value change. So what's kind of the economic wealth of a company? That's one end. The other, that very subjective. That number is subjective. On the other end of the continuum is cash flow. It's very objective. Okay, did you get the cash or did you not get the cash? So those are the two ends of the performance measurement continuum. Where does financial reporting fall? Financial accounting, right here. We call it accrual. That accrual means we just make assumptions to give us a number as close to this economic income as we can get. Let's not look at actually what the cash flow was, and let's not look at the legal niceties. Let's look at the economics of things and say, what's the economic performance? So accounting income, as good as accounts can do, is a measure of economic income. It's not perfect, but this accrual notion means we're going to try to measure economic income. We're going to try to get it actual economic performance and value changes and those things. Well, that doesn't work for tax purposes. For tax purposes, you need an objective rule because the tax rules are the law. And somebody needs to know, am I obeying the law or am I not obeying the law? So taxable income is closer to cash flow. So these two sets of books, the financial reporting or accounting books, are more like an economic measure. The tax books are more like a cash flow measure. That's how they fit in this continuum. Now, if this were a tax class, which it's not, but if it were, I'd tell you a little bit more about this box right here. Why do the tax rules need to be objective? Well, it's to reduce arguments. Why do they need to be based on cash flow? Because you pay the tax when you can pay it. You know, let's say I make $20,000, but I haven't collected it in cash yet, and I won't be paid it for 2 years. Well, I can't pay the tax now because I haven't collected the cash yet. So tax rules are often based on cash flow. And of course, Congress in the United States has used the tax code to do all kinds of social tinkering. Let's not even get started talking about that. Are there two sets of books? Yes. The financial accounting books, the balance sheet, the income statement, the statement of cash flows, an attempt to measure economic performance, economic situation of the company. The tax books are closer to cash flow. Let's just get this tax collected in a reasonable fashion. Two sets of books, and the tax books are overseen by the IRS. The IASB, the International Accounting Standards Board. We already know that inside the United States, the FASB establishes the accounting rules inside the United States. What about the rest of the world? In the rest of the world, the IASB establishes the financial accounting rules. So the IASB, based in London, they make the accounting rules for the balance sheet, the income statement, the statement of cash flows, use in the whole world, except for in the United States, where the FASB makes the rules. And you say, well, that's not good. There should be one worldwide standard. Well, the good news is this: there's been convergence over the last dozen years. The differences between the international rules set by the IASB and the U.S. rules set by the FASB have been reducing recently, so it's really close. There has been great international convergence, which is good because we want to be able to compare the financial statements of a Japanese company and a German company and a South Africa company and a French company and a Brazilian company and a Canadian company. We want to be able to compare them all. So there's been convergence. Yes, there has been convergence between rules in the United States, the FASB, and the rules in the rest of the world, the rules in the United States, the FASB, and rules in the rest of the world, the IASB, but they haven't come completely together. And even countries where the rules are the IASB rules, the international rules, they're still applied a little bit differently in different countries. And that's the big barrier to complete international convergence. Who's going to enforce these rules? Is there going to be an international accounting police force that's going to wander from country to country? And what country is going to allow the international accounting police force in? And national politics. Do the Chinese or the Russians or the Brazilians or the Peruvians want their accounting rules set by this bunch in London? And do U.S. companies want their rules set by a bunch in London? How's this going to work? So national politics and who's going to enforce these rules are slowing down, a little bit of a barrier to international convergence. This, by the way, we could have an entire course, and there are entire courses on this one screen right here. This is fascinating, this worldwide convergence of accounting rules. It's exciting. You can feel it in right now. Today is an exciting time to be studying accounting. In the history of the world, if you get a choice of studying accounting anytime, today is when you want to be doing it. This is the day. What are some hot topics in accounting right now? Well, this whole issue of international accounting, convergence, all accounting rules from around the world coming together. That's big. And that's happening today. In the whole history of the world, it's happening right now. Information technology is exploding all over the place, got a huge impact on accounting, and increased government regulation because financial markets are becoming more important. Accounting is important in financial markets, and people can be helped or harmed through accounting. So governments are interested in this. International accounting convergence. Let's think of a couple of questions here. Will the United States Congress allow the financial accounting rules to be used in the United States to be set in London by people over whom the United States Congress has no authority, no control? They can't even get their hands on them. How about the Ministry of Finance in China? Will they allow accounting rules for Chinese state-owned enterprises, which are majority owned by the People's Republic of China? Do they want those rules set in London? So you see the issue. Yes, lenders and potential investors around the world want everybody to be using the same accounting rules. But I'm in Brazil. I don't want my rules set by somebody in London. I'm in France. I don't want my rules set by somebody in the United States. Everybody wants convergence, but not everyone wants somebody else to do it for them. So this is a huge controversial issue, a very hot topic. Twin barriers to the convergence of international accounting rules are enforcement. Who's going to make sure the rules are obeyed? And in the United States, within the United States, that's easy enough. There's the SEC. If you don't obey the rules, the SEC has power to see that you go to jail. But there is no international SEC. There's no United Nations equivalent of the SEC. So who's going to enforce the accounting rules? And different nations have different political needs. And they want their financial markets to have this flavor, to have that flavor. They want their national companies to be benefited in this way. They don't want to disclose too much to people outside. So all kinds of national political concerns here. Well, possible compromise is something called condorsement. I don't know if this word is going to live, but it's a nice idea. The idea is this, that there's an international body of accounting rules set in London, for example, by the IASB, but each country will then say, okay, we like that rule and we will officially endorse it for use in our country. So yeah, the rule, the general set of rules is established in a uniform way, but each nation has the option of saying, yeah, we'll take that one, we'll take that one. And of course, the market pressures would be on countries to go ahead and pick them all, because you wouldn't want to be the country that says, yeah, there's the rules that everybody else in the world uses, but we don't want to use those. Well, what's wrong with you? Why don't you want to use them? So that's called condorsement. Rules set centrally, but then legally adopted and enforced locally. We'll see how this plays out. And this is playing out right now. This is a very exciting time to be studying accounting. Technology impacts everything information technology does. So, of course, it also impacts accounting. You may have heard of XBRL, Extensible Business Reporting Language. Accounting reports now, instead of being pieces of paper, they are computer files where we say, okay, let's link on that number right there. That's the cash number. And can we write a computer program that will pull the cash number out of the financial reports of Apple and Microsoft and ExxonMobil and Google and all of them at once? I mean, if it's out there in their computer files, let's structure things. So XBRL is the attempt to structure all the accounting data so we can easily go and get the land number, the net income number, the operating cash flow number from all kinds of different companies at the same time. Makes the accounting information a lot more user-friendly. Markets react very quickly to information, because information technology makes that information available now, and boom, it blasts it out. I remember long ago in 1985 it was, I visited the SEC in Washington, and if you wanted the annual report of a company that they sent in to the SEC in Washington, you had to sit there. The company would bring it in. They'd hire some attorneys. They'd bring it in. They would accept it. They'd put it in a shopping cart. It would get processed, and a couple of days later it would be put on the shelves and you could look at it. That's what it was like in 1985. I watched that process. These days, when a company sends in their financial statements to the SEC in Washington, it's blasted out on the web to everybody who wants to see it right now, immediately. Markets have access to all kinds of information. Information technology has made that possible. So accounting is dealing with this. For example, how much information should investors have? Should investors, let's go to the extreme. Should investors be able to tap into Walmart's detailed transaction by transaction sales database and find out what Walmart's sales were for the last 5 minutes? Can we have access in real time? Well, so far, the SEC in the United States has said, no, you tell it to us every quarter and that'll be every 3 months and that'll be all right. But the technology exists to require Walmart to say, tell it to us every minute, tell it to us in real time. How much information should investors have? This is an issue among other technology related issues that accountants are wrestling with even as we speak. Increased government regulation, I should say so. We've got the SEC, we've got the Sarbanes-Oxley Act, SOX, we've got the PCAOB, looking at many different things, but one key focus of all of these is accounting and the information. See, if people are going to make decisions that are going to impact their livelihood, investment decisions, lending decisions, they want good information. And these government regulators inside the United States are there to make sure that that information is reliable. They're not there to make sure that people don't make foolish decisions. They're just there to make sure that if you're going to make a foolish decision, at least you had the reliable information on which to base that decision. Good or bad, it's your decision, but you got the information. So yeah, there is increased government regulation on accounting. Now, accounting may seem boring to some. Boring. Accounting's not boring to me, and it's not going to be boring to you either. And we're going to illustrate this by just some of the scandals and things that have happened over the last few years. Enron, WorldCom. Enron and WorldCom were part of a meltdown in public confidence in financial accounting numbers that helped contribute to a $2 trillion loss in the market value of stocks in the United States. I mean, there are other factors, economic factors, but the fact that people said, I can't trust the financial accounting reports. I don't know how to whether to loan money to a company or not because I can't trust the reports. I don't know whether I should invest in companies or not because I can't trust the accounting reports. At least part of that $2 trillion drop in market value is because of a lack of confidence in accounting. Accounting for derivatives. Enron was big into that. Exaggeration. WorldCom did a lot of exaggerating, so it reduced the credibility of accounting reports. Bernie Madoff just did out-and-out lies using many techniques, but accounting was also part of those lies. Why do I use each one of these three, by the way? Because the CEO of Enron, the CEO of WorldCom, and Bernie Madoff himself are now sitting in federal prison because, among other things, they lied about accounting. They did accounting badly. To my view, boring. Anything that can cause me to wind up in federal prison is not boring. That's something I want to know about. That's the downside. The upside is this. If I understand accounting well, I can make better decisions. Accounting is focused on helping me make better decisions. Do you want to make better decisions? And do you want to keep out of federal prison? Of course you do. So let's study some more accounting. This is an exciting time to be studying accounting.